The new realities of global oil markets are yet to convince economic policymakers in Algeria that it's time for a radical rethink. Unlike the rest of Organization of the Petroleum Exporting Countries as members with the exceptions of war-torn Libya and sanctioned Iran, Algeria has steered clear of tapping global debt markets 3 years into the oil price slump. Neither will it overhaul laws to attract more foreign investors. A cabal of aging leaders sitting at the top of the party that delivered independence more than half a century ago is united in its opposition to mortgaging the country's future. Instead, the North African nation has run through almost half of the foreign reserves it accumulated during the oil boom in order to avoid cutting welfare benefits as a sensitive political transition looms. President Abdelaziz Bouteflika, 80 and who has rarely been seen in public since suffering a stroke in 2013, has no clear successor, meaning a period of jockeying is already underway. The remaining $100 billion plus can buy policymakers time, but delaying reforms risks inflicting a greater toll on an economy struggling with sluggish growth and one of the highest current account deficits in the Middle East. Authorities are not taking into account the new realities associated with lower for longer oil prices, given that the drop in reserves is unlikely to reverse anytime soon. Economies across the region need to fundamentally adapt to a new model of economic development, and issuing international debt, and also deepening local capital markets, is a part of this process. Members of OPEC have raised tens of billions of dollars from the sale of international bonds since 2014, capitalizing on low interest rates and increased investor interest in riskier assets. Aversion to foreign debt is rooted in North Africa's colonial past. In Algeria, national sovereignty has turned into an obsession, due in most part to the 7-year war for independence from France that ended in 1962. It can also be traced to a debt crisis during the 1990s when the government was forced to accept International Monetary Fund-imposed austerity measures. Rising oil prices since then have allowed the nation to repay its obligations, cutting its external debt to less than 4% of economic output at the end of last year, according to IMF data. Officials will do anything to avoid borrowing money. The problem is that they can do this for 1 or 2 years, but it's clear that by 2020 this will not work. To be sure, the oil slump hasn't battered Algeria's public finances in the same way that it is in Saudi Arabia, Kuwait or Venezuela. The budget deficit, forecast at 3% of gross domestic product this year by the International Monetary Fund, is under control. The fund, in a report issued in June, also welcomed plans to reduce the budget deficit and improve the business environment. As far as issuing international debt, for the moment, it is considered that there is no real urgency since the financing of the deficit can be ensured by mobilizing internal resources, such as selling domestic bonds and borrowing from institutions such as African Development Bank, said Alexander Kateb. The nation tapped both avenues last year. But the Washington-based lender warned that the current account deficit, which measures incoming and outgoing goods, services and transfers, was significantly weaker than warranted by medium-term fundamentals. It expects reserves to drop to below $40 billion by 2022, enough to cover 8 months of imports. Aversion to international borrowing means that financing the deficit will be more difficult than in the past, and may drag economic growth down to 0.7% next year, the fund said. Other recommendations included opening the economy to trade and foreign direct investment. Algeria ranks 156th on the World Bank's Caesar Doing Business Index, below Niger as well as the West Bank and Gaza, the Palestinian territories stuck in a decades-long conflict with Israel. Algeria has always been a slow reformer. It's a rigid society. Going forward, you can expect a small currency depreciation, fiscal consolidation, but strong resistance to privatization. And things will have to get really bad, as in $40 oil and a large deficit, before authorities would move to implement other IMF-recommended reforms. Abdelaziz Bouteflika, a bureaucrat who served as Prime Minister for 3 months this year, said in July he was under instructions from President Bouteflika not to resort to external borrowing, regardless of the situation. He was replaced this month by Amadou Yahya, a veteran politician now serving his fourth term as premier during the last 2 decades. Sergei Dogatchev, who helps oversee about $14 billion in assets as a senior money manager at Union Investment Privat Fonds in Frankfurt, said Algeria would be a very interesting investment case and would attract good interest from investors should they issue bonds. The key risks will be getting a transparent and fair picture about what is really happening economically and politically on the ground, he said.